Investing insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
G'day everybody, Steve Waters and Victor Kumar back for our first podcast of 2021.
Yes, Stephen, you look a year older already.
I'm actually still younger than you, and will ever always be younger than you. Nonetheless, knowledge is in years, so they say. How was Christmas?
Christmas was good. Like most people, plans got in total disarray with the border closures, but we came through it unscathed, and perhaps with a credit card bill that wasn't as heavy as it usually is because we couldn't go anywhere.
Well, the trick to that is don't have credit cards to begin with because it affects finance.
True that, it does, yeah. And in fact, that's a great segue into what to look forward to in 2021, which is finance, because as with everything, that is the key to investing.
It is, and it will always be that way. And whilst there's a lot of narrative and opinion around what finance will do over the coming months, especially with the pivot from responsible lending to responsible borrowing, and how it should theoretically become more easy to get credit, I'm not sure there's going to be this massive difference from black to white, so to speak, where suddenly you're borrowing 50% more, or you have the ability to borrow 50% more, because there are a lot of people looking at the market at the moment hoping that it doesn't have a runaway effect where that potential APRA handbrake may be pulled in the years to come. Now, on that, APRA, we're paying, I think the ramifications of what APRA did yesteryear and sort of cutting all investors out of the market has been partially what has been created today in terms of lack of supply, raising rents, asset value, et cetera, et cetera, et cetera. And whilst they'll never have that perfect balanced point, hopefully they've learnt their lesson. But we'll get to that a little bit later. Question for you, while you were on holidays, did you buy a holiday home? Because I know we were talking about it
That's right,
beforehand.
Yeah, exactly. Yeah. No, I did not. I learned that lesson many, many years ago. Never to buy a property when you're on holiday, particularly at your holiday destination. But a lot of people that I have spoken with have actually attempted to, or have actually gone forward and bought it, because they're now looking at things from a different filter, right? To say that, okay, I can work away from my daily commute. Maybe this is the place to be. And I think what's happening now is that a lot of people, when they're doing things in an unplanned way, are really setting themselves up for quite a sizable disaster in the years to come, as things return to normalcy, when the employers start saying, well, you've got to come back to the office. Interest rates start going up, and you realize also that living at the holiday destination wasn't all it was trumped up to be, because you're still working and you're not actually enjoying the facilities.
And I think that's a really good point, because we've always been advocates of reacting to markets, as long as there's that preparation and diligence beforehand, and you know where you're going and why it fits into the initial stages of a portfolio, or addition number 100, whatever it may be. However, this COVID scenario, and to some degree take away the health aspect and the like, has become the biggest social experiment we've ever seen.
Has it ever?
And people are reacting from that point of view as though this is the new norm. There will never be an office environment again. Everybody will work remotely for the rest of eternity. And I just don't see it panning out that way. Sure, the workplace as we know it has changed eternally. However, it isn't this 180-degree separation from the past. And we need to be very careful when adding to the portfolio, whatever we purchase, that it actually has sustainability.
Yeah.
And that it's still an agile investment, not a fragile one, where you'll be stuck with an unwanted asset that really nobody wants, or a very small slice of the market will want, and therefore it backs you into a corner, whether that be financially or to move forward, whatever it may be.
In other words, we need to take the COVID filter off and still look at it from an investment in a normal market, because right now, one could argue that it is an abnormal market, and it's abnormal not because of the market fundamentals, it's abnormal because of the psychology of the investor.
Behind it.
Yeah,
correct.
right.
The psychology of the investor, actually the psychology of everybody has changed, and thanks to COVID, and whether that be a positive or a negative, it's changed nonetheless. but it's not the new constant.
No, it's
Not
not.
every aspect of it is the new constant. And as a result of that, there are going to be decisions, as you mentioned earlier on the decisions that we make today, and the opportunity that we potentially execute today still needs to have longevity.
Mm-hmm.
It needs to be still performing as though COVID never existed.
That's right. Yeah. Number one rule of investing is understanding that it's very easy to get into a property transaction. It's substantially harder and more expensive to get out of it if you've got it wrong. So you need to make sure that the property that you buy is in line with your particular financial fingerprint and is also in a liquid area. So what I mean by that is that in the hard times, you're still able to sell this down, and it's not a unique property as such. Where I'll bring an example from my portfolio, which I think you already know which one I'm going to talk about. This is the serviced apartments up the coast, which we bought some 10, 12 years ago. Now, it's got several wards on it. So it's a serviced apartment, and it's also in a holiday-let area managed by a hotel group, right? So ticks on all boxes.
And off the plan.
And off the plan as well, yep. So when you look at it from a financing point of view, already we've cut out a lot of lenders that don't like serviced apartments, especially if they're managed by a hotel group, right? So that's half, if not 3/4 of the lenders gone. Then we've also then cut down in terms of the people that can buy it off me, because the loan to value ratio on this is likely to be 60, at the
On
best
a good
case.
day, yeah.
And the valuation is going to be harder to achieve. So it's something that is not liquid, right? So in a good market, I'm talking about a good market, you'll get 60% LVR on this. What happens in a bad market? Right? This is simply not a property that you'd be able to sell easily. So you'd have to take a bath on it. It could actually derail your entire portfolio, because if I look at it from my viewpoint, if I look at it from my viewpoint, I still get a lump in my throat when I talk about it.
He's tearing up.
So if I look at it from the view of my portfolio, this is by far the only negative cash flow property, because the management fees are so high. And when you want to use it, that's when the cash flow is at its peak, right? So you can't actually, from a financial point of view, use it. And when you don't want to use it, it's usually vacant, which is during the winter months. So this is something that it's a good lesson to say that, you need to be looking at the property as if things will go wrong. And you don't want to be caught in a situation where it is very hard to get out of it and continue the portfolio.
It's an interesting point, because, and I've got it up here in front of me, I had a very similar question to a holiday let area or a coastal region at the end of last year, where someone said to me, are we seeing the new norm where these coastal regions, which were potentially were a subpar performing area pre-COVID, but are we going to see this now, this transient shift to these areas because of remote working capabilities and et cetera, et cetera, et cetera. And what it did is it made me think about the different types of investors but taking a constant approach. So trying to take out the peaks and the troughs of markets and the crisis and the good times and the bad times, and try to categorize not the human side of an investor, but just the types of investment. And so I wrote some things down. So go with me on this. The first one is value investing. So are you a value investor? And I deem myself as a value investor. It doesn't matter what it is that I purchase, whether it's a property, a car, a pencil. I want to know that I'm extracting value from it. And so essentially the main idea of value investing is that the price you pay matters. Yeah. Now on the surface, everyone says, well, it always does, but it's not. So keep going here. A contrarian investor.
That's a good one.
Yeah, I thought so. Where you're actually just doing the opposite of what everybody says. So, like a Warren Buffett scenario.
Yeah,
or COVID beginning. Everyone was running to the hills.
Yep.
Thanks to the narrative and the media around it. But those that really knew what it was all about was actually diving headfirst into it. So being a contrarian investor. And then the next one was growth at a reasonable price. Now, what that is, in my opinion, is that you're willing to pay a fair price for the growth, being the fundamentals and everything that are around it. And historically, if you want to sort of throw that into the pot, is paying a fair price for a good asset that will return and grow in value over the future. Then we get to momentum investing. And this is kind of where we are at the moment, where a lot of people are going to be at the moment. You could almost put that as FOMO investing.
Yep.
Yeah. Now that the unsophisticated version of it. So momentum investing is riding into a market where a rising tide is lifting all ships, so to speak, and you just want to be a part of that. And price kind of isn't too much at the forefront of your decision.
So you're more or less transactional in nature.
Correct. Transactional and potentially transitional.
Yep.
Meaning that you're not really looking too much into the future. You're just trying to get onto the growth gravy train. And it's this one, if you get wrong, that will hurt you the most, because it's usually in a subpar area that is having over and above normalized average growth because of whatever the reason may be. It could be a mining town. And so therefore timing becomes, to be profitable, timing needs to be impeccable.
Yep.
So momentum investing. And that's about as far as I got. But it really does categorize all of us in one way, shape or form. And you could nearly have one or two of those aspects at any given time.
Yeah.
There might even be all five of them might be sort of small parts of the profile of a successful investor.
Yeah, a good, well-educated, well-rounded investor would have all of those things.
Absolutely.
But with checks and balances. So as an example, if you talk about the momentum investor, there are a lot of current affair stories about these investors as well, where they've followed the horde, they've followed investing via media and jumped onto an area too late. So towards the peak when everything became public knowledge. Or secondly, they have jumped in the right time, but they've failed to monitor it and they haven't been able to jump out at the right time.
At the right time. And that actually, I missed one of the profiles, which is growth asset investing, which is basically what you described, meaning that you're buying cash flow. You'll pay a price in terms of entry because of the amplified cash flow at the back. So that could be a subpar regional area with 13% yields and you're paying for the privilege. However, those amplified yields are usually more illiquid and they're also more dynamic in terms of their peaks and troughs. The distance between the peaks and troughs is the million-dollar question in terms of how long does that market run for before there's an abrupt halt.
And it is, the change would be very sudden in those areas usually.
And it's not, exactly, because it's not a gradual process. It's not where we start, well, here's 4 or 5 indicators that is going to see from peak to the initial stages of contraction in either value or cash flow. It's not going to be a 3 to 4 year process. It's going to be very, very quick. A mine closes down, as an example. Or the new laws are that it's impossible to work from home because of OH&S. I'm just clutching, but so therefore everybody needs to go back to the office and environment. There are all of these things we need to consider, and there's all 5 aspects in a well-rounded investor, as you said earlier on. It's just that it's the timing and the education piece behind it, knowing when to be more of one than the other.
Yeah, and the only way you can do that is when you dive into the back end of stuff, in terms of what makes that area grow, what's keeping it constant, and why is it no longer value to you. Now, it could still be value to someone else, right? But it could no longer be value to you in your portfolio, because by adding that type of investment or that type of property in there could actually stunt the growth of your portfolio, because then it locks you up. It does not allow you to grow the portfolio further, or even something as simple as it doesn't allow you to restructure your mortgages to get the cheaper rates because you have 1 or 2 unique properties in your portfolio.
Correct. And so the reason we bring this up is because of this potential, I'm going to call it a bull market that we generally might be going into, that people will start to shortcut the process.
Because they're keen to get onto a property.
Because they're now all loaded in terms of, I come back to the investment profiles of a momentum investor.
Yeah.
Whereas I don't want to miss out. I just want to ride that gravy train. All I'm doing is thinking about the growth for the short term, not about the sustainability of it, which might actually then stop and lock me into a position where I can't do anything. I become, here's the sixth investor profile, the illiquid investor, which means then you're stuck.
Yep.
And you might have to wait another whole 8 years for that cycle to re-perpetuate, whatever the trigger points are, to be able to move forward again. So there are many, many different scenarios that we've modelled out over the last 12 months. And even when COVID first hit, we were very public in terms of, well, this is how it will play out, and we're confident that it will, and it has. And we still need to make sure that we're addressing, I'm getting a little bit over the word fundamental personally, because it should be just a given, but I'm going to use it. So we still need to make sure that we have sustainability. The decisions we make today needs to enable us to have sustainability for the medium term and long term. Otherwise, we're going to go backwards.
That's right. That's right. And if you look at when COVID started, everything was doom and gloom and very pessimistic, right? Even the media was saying 30, 40% decline to now where they're saying 15, 20% increase in value, right? So as it was during the start of COVID, where everything was pessimistic in approach, we still needed to make sure that we took that, but we didn't get influenced by or paralyzed by the pessimism in the market to stop looking at our portfolio and adding to our portfolio, even taking away from our portfolio. The same comes back right now, where we are very optimistic and very bullish about the property market. So very much so, we still need to, and again, using the word fundamentals, still need to go back to fundamentals to say that, okay, yes, this is the filter right now. We need to be able to take ourselves away from the buoyancy of it to come back to my own situation, to see how I can take advantage of today's market based on my circumstances, based on my portfolio, and based on my goals, rather than trying to invest via media, where the media says, no, a good example is regional areas have grown the most in the last 24 months, right? And you take that with a grain of salt, because there are a lot of overlying factors in there. And in fact, coming back to your comment about what happens when normalcy comes in and the employer says, come back to work, what happens to these regional areas? Are there employment nodes close by? So this is something that we need to look at from a holistic point of view, rather than just, here's the data set right now, and I'm going to make my decision based on this. You need to still be looking at it from a medium to long-term view.
And if you're investing via media and the narrative that they create, and even some economists and the like, so you mentioned the big banks and everything like that, not calling them out individually, perhaps collectively, is that how much credence are you weighing in on their opinion, considering how quickly it changed and how fickle it was, where they were adamant that the market was going to collapse. There was no ifs or buts. It will collapse. It's just a matter of by how much. And now what? 8 months? I'd say it'd even be 6 months since that narrative has changed 180 degrees.
Absolutely, it has.
So where is the belief? How do we as the public actually give them any weight in terms of their opinion?
Yeah, because there was no magic switch that happened where it says, okay, no more pessimism, now it's optimism, right?
Yeah, it's not like, well, let's flick that switch or here's a major indicator for us to change our mind or even create the decision to begin with. And I'm sure that there's a lot of people out there that are very well educated that demand that you listen to their opinion because of whatever the reason. I'm not going to get down that rabbit hole. I'll change tack. But the fact is, if the belief in their rhetoric is solid, then your opinion will change accordingly as the wind blows, because theirs does.
Yeah, that's right. Because they're looking at sets of data and forming an opinion and say, okay, if this set of data continues, this is what's going to happen, right? But the data itself, just because you've said, it's going to do this, is not going to do that, because we're dealing with human beings and we're dealing with economy where it's not governed by just the one aspect. There are many different aspects that control the both the local, the sovereign and the global economy in itself. So it's not something that can be set in stone. We can predict, and that's all it is, predictions.
which is another word for modelling.
Which is another word for crystal ball gazing.
Which is another word for assumptive investing.
Yeah.
And to some degree, all investing is assumptive because we never know what the future holds in terms of being 100% correct. But if we're looking at all these indicators, then we're okay. But to take the opinions of people without any real understanding of why that opinion is even being tabled is just silly, which is why you would have heard a lot of people in our space, and collectively, I don't think there was one of us that I have respect for that was of a different opinion. We were all saying, well, here are all the indicators that to say that as to give reason as to why every single one of these people are saying that the market is going to collapse by 10, 20, 30, 40%, whatever it may be, are wrong.
Yeah.
It wasn't us individually. Collectively, we were all saying it because we are on the ground. The way that we interpret the data is not textbooked, style, if you will, relying upon algorithms and taking away the human emotion out of it. It was an absolute lay down misère for us that it was not going to happen the way that they predicted. Now, if this is not us grandstanding and saying, well, maybe we should be the next economist of the banking system. I'm not saying that, but sometimes overcomplicating the data is far more dangerous than actually doing nothing or believing in it.
Common sense needs to prevail. That's the bottom line. Yeah. So here's a really good example of how you can't just simply rely on data. And this is one of the things that we do when we're evaluating a property. Let's say we found the perfect property, good rental prospects, nice solid house, good street. Yet we fail to evaluate the neighbors, right? We've got a hoard on one side and a guy that plays loud music on the other side. What's going to happen to your tenancy? It's going to be impacted, right? So data is all said that this is a good suburb and all that, but that particular street or that particular cluster of homes is not the right one, right? So this is where you need to take the data and interpret it on the ground.
It's almost like saying population growth is a prerequisite to asset growth.
Yeah.
And it's just not
true. Look at right now. We in a lowest population growth in Australia, yet we've had increase in growth.
It's zeroed out.
Yeah.
And well, take even an individualised suburb where they might change the election council zones in half the population, or it's a transient sell-off of government housing.
Yep.
Yeah, there's a million reasons as to why that is just not the number one rule to investing. Find the place with the population growth the most and you'll make money. There are so many different filters that need to be overlaid before you can get to that decision. But we've gone down a rabbit hole there.
Yeah, we have to.
As we do. And we've got on our soapbox. And I think the reason that we probably have without knowing it at the time, before we entered this conversation, is because we can see the beginnings of a lot of people making the same mistakes
as they did in the yesteryears,
as they did last cycle and the cycle before that, because of the lack of, or maybe because of the right understanding of the correct education that they do need, or the diligence that they need. If you implicitly hand over your decisions to someone else just because you're paying them or whatever it may be without any due diligence on your behalf is just stupidity.
Just remember, you can't outsource your push-ups.
You can't what?
Outsource your push-ups. You have to do them yourself. So in other words, the due diligence you're going to do yourself. You can't pay someone to do the push-ups so you can become fit. That's a new one for you, isn't it?
Just trying. Where do I go with that? You can't outsource your push-ups. We'll put that into one of the investor profiles as well. So let's get back on track, and we'll do the fitness podcast
later.
It clearly you can see that we are. So if we talk about the things to be aware of, the things to not believe, and the things to believe in terms of the COVID scenario that we're in the middle of, because it hasn't finished, nor will it for that foreseeable future, what would be the number one thing or factor that you would suggest, not just to a new investor, but to all investors, to be wary of, to consider all the time?
With the COVID filter on or off?
On.
Yeah. I would still look at it from, first of all, you need to set up a plan, right? So there's three processes to this plan. First of all is actually sitting down with someone and running through your goals and what you're trying to achieve. Now, I use the word goals loosely over here because a lot of people, when they do get started, it's not clear, right? But they do want to get started. So what does the first property look like to you in terms of what you're trying to achieve? That holds it down and you match it to, okay, does it really make sense from my financial point of view? And by buying this type of property, forget area at this stage, right? By buying this type of property, will this now lock me up so that I have no level of movement at all if finances change and the mortgages, the interests will start going up, right? So that's the first thing. Then you actually need to go in and restructure all of your mortgages and get the finance in place. Then you look for, okay, how can I make this finance fit into a property that suits my needs? And that's the process that you go through. Realistically, if you're starting from scratch today, you really need to set yourself perhaps a 90-day plan to go through this whole process and have settled a property by then. What most people get wrong, given today's market and given a market that's bullish, is they are too eager to get started and they buy perhaps the wrong property to begin with, because there's several types of properties in a portfolio. First of all, you've got to have your foundational properties. They are your pillars where it can prop up all of the other properties that you can buy off the equity or off the cash flow of these properties. Then you've got the filler properties where it'll fill in the nuances of the or the cash flow nuances of the portfolio. So such as one of the things that we say is pigeon pairing it. So if you've got a high growth property, you'd go for a cash flow property next to balance it out if your finances dictate that. And of course, you still need to be looking at it from a helicopter view to say, okay, where is this all heading? Don't get so caught up in the individual transactions that you're failing to lift your head up and see where the entire portfolio and where the journey is actually heading towards, and constantly correcting with the currents of the economy, the currents of the rental market, the currents of the value proposition and the market sentiment. You need to correct against that to be able to be on course.
It reminds me of something that we said a few podcasts ago, where cash flow is the expansion joint.
Yes, it is.
That takes up the ebbs and flows of the building, so therefore your portfolio. Yep. You need that piece in the middle, if you will, to be able to absorb the different movements within the portfolio. So essentially what you're saying is planning.
Yep.
Still.
Yeah. But, in one of the podcasts we had said, right, most people go ready, fire, aim, right? We need to go ready, aim, fire. But there's also the other investor that goes ready, aim, but they never fire, right? So you want to be a ready, aim, fire investor.
And that planning process is quite intricate. It's not just a one size fits all and
Correct.
Everybody's in the same boat. Yep. It's got to be quite tailor-made, if you will. But more to the point, also with the finance scenario, now there's a lot of people that you'll see along social media saying, book your free strategy session.
Yeah.
And for me, that's kind of counterproductive. How can you form a strategy without knowing what your capacities and thresholds are? Not just personally, but what the bank is willing to lend you. You might have, someone might say you need to purchase in, I don't know, eastern suburbs of Sydney, and it should be around, circa $1.5 million, because historically that's where the best average growth is, et cetera, which we've never believed, and we try to explain away that. But if you only have the capacity to borrow $750,000, wrong area. There's just been a whole heap of time that you've wasted, and more importantly, the person that was giving you that advice didn't take the time to understand your situation, your capacities.
That's right. So most of these, and I'm not bagging any providers out there, right? But most of people's approach is this: you're going to a service provider, and it's here's something I prepared earlier that gets served to you straight off, right? It's like going to going to Macca's. And as you walk up to the counter, the employee rings up a Big Mac without even asking you. Yet you could be just there for chips or their rolls, and just making this up.
That ties in really well with outsourcing your push-ups.
That's
If you're at McDonald's and you're clearly outsourcing your push-ups.
Yeah. So they're not taking into account what you want and what you need. Instead, they're just pre-filling your order, right? Now, this is what most people, when they're investing and they're hiring a professional, unfortunately, that's the path they go down because there is no consultative approach. A true strategy is only built once you've got a concept plan, you've got the finance in place, and then the strategy is honed down along with the concept plan, taking finance into account. Good point,
because it's reverse engineered based on those
Yes.
numbers. Because there are two types of affordability, because that's kind of what we're talking about here, whether we like it or not. It's one, what you know you can afford, and two, what the bank says you can afford, or the lending institution.
And they could be very different.
Very, very different. Or another example might be that you could have the approvals from the lending institution to borrow $1 million, but you've got $40,000 worth of capital.
Yeah.
Those two numbers just don't...
They don't match.
They don't match.
Yeah.
So this is where booking your free consultation, your free strategy session is actually a total counterproductive position, and it's a waste of time until you understand what those numbers are. So if we go back to what you were saying earlier on, in terms of ready, aim, fire, rather than sort of ready, or ready, aim, it is going to hinge around that financial piece.
Correct.
Because everything will be a factor of that. Now, that doesn't necessarily mean that before you do anything in terms of consulting with someone that you need to speaking to a broker first, because maybe the consultation will point you in the right direction of the questions you need to be asking, because the quality of your answers is going to be determined by the quality of your question.
Correct.
So there's several moving pieces here
Yeah.
that we need to take into account, but it doesn't happen within 3 days.
No.
And that time period will actually get longer and longer and longer as more people enter into the market. In fact, just before Christmas, I know one of the major banks I think it was nearly 20 days before they picked up a file.
Correct. Just for assessment.
Just for assessment, not even mentioning that they need more information, but you go back to the bottom of the pile and then the cycle starts again. So the longer that we take now will be the longer that we clearly get into the market while everybody else does. Brings me to another point, though, in terms of the market conditions. And we'll just go sideways a bit here at the moment, because there's certain parts of the market today, and this will tie into preparation potentially. There are certain parts of the market today across Australia, several markets across Australia today, where I have not seen the stock on market this tight in 20 years.
Yeah.
In fact, I'm going to say ever.
Yeah.
Like it is historically low. In where traditionally in a normal market you could go onto one of the .com platforms and there'd be, let's call it 7 pages of properties for sale. Today there's one page with maybe 12, we'll call it 20 listings, of which out of that 20 listings, 80% of them are under offer. Yep. Or it's bait advertising just to make you ring them to collect data. I've never seen it this tight. Now, that doesn't mean that we're into a runaway market. It might be a moment in time because of a number of factors, which we'll get into in a minute. Nonetheless, it comes into the preparation side of the ledger, whereas when the opportunity presents itself, if you're not prepared, if you don't have that finance in place, you're going to miss the opportunity. There will be no renegotiation of contractual terms in that cooling off period. As an example, can I extend? The seller and the agent are going to say no. So you need to have all of your ducks lined up now.
Finance.
Right. Yeah. Once again.
This is where the ready comes in.
Finance and direction.
Yes. Yeah. And if you look at, what's happening in the market right now in terms of the stock on the market, this is understanding the process in the various states, right? So as an example, in New South Wales and Victoria in particular, a solicitor needs to prepare the contracts first before the agent can actually market it. Right, so that's the law there. So most solicitors have come back on the 11th or 18th of Jan. And if the agent has signed the vendor up to sell the property, he can't do anything until he's got a physical contract in his office. So when the solicitor comes back, of course, there's a backlog of the more urgent matters. So it'll probably be a week before he picks up the file. And the first thing they need to do, if it's in New South Wales, is order the 149 certificate and title search and all that from council, right? Takes a couple of days. Then they collate everything, they send it to the agent. and they may have a few things wrong, so they'll add another day there. So before you know it, now 2 weeks have gone. Then the agent books in the photographer to get some professional photography done, and then loads it up on the net. So another 3-4 days have gone by before it can get launched on the market. So before we know it, we're into February, right? And this is traditionally, January has been a low listing month. The listings are still there; they can't market it, right? But given COVID and people are sort of, in my opinion, sitting back a bit to say, let's see how it pans out over December before we come back. Or they've used this Christmas period because they haven't gone anywhere to rationalize where they're going to live. Will they offload their property to buy a better one, or are they going to offload to pay down debt? And there's an influx of properties coming in. So it's a matter of understanding where various markets are and how the mechanics work before you really start changing your investing criteria to match the market. So
opposite of trying to catch a falling knife in a bad market, you don't want to be trying to catch the helium balloon.
Yeah,
in a reaching.
That's right.
in a good market. But there's a couple of other indicators there which I've thought about as well, and clearly the cost of money is as cheap as it's ever been.
It has been.
The fiscal cliff, so to speak, around JobKeeper, JobSeeker, in combination with the mortgage holiday has not, as we said it would, turned into this major negative event.
There's no major mortgage in possession sales.
Correct. And as a side note, in fact, I think I read the stats the other day, mortgage holders are the most in front they've been since the 70s.
Yep.
I think it was. And not even slightly. We're talking 4-5-fold.
I mean, the savings rate has been phenomenal.
Yeah, savings, basically, which is for anyone who has the property, it's probably in their offset or something like that. Yeah. But there's a big component of people out there that were waiting to see how the market would unfold and whether they should pull the trigger and sell to minimise a loss. That was the sort of the rhetoric or the thought process between their ears. That's now changed to saying, well, hang on, I'm hearing about all this boom market potential. Maybe I should hang on, because I can, to try and catch a bit of that boom market and sell it at a higher price. So they're withholding from the market. And the third factor is that there's a degree of homeowners out there, investors or occupiers, which were going to sell because they were upsizing, downsizing, sideways sizing, whatever it may be. But if they're looking for another place to purchase and there's nothing out there for them to purchase, they're hanging on to the existing property until they see more stock on market and they have better choice. So there's also that imposition in terms of stock on market. When you throw all of that into the pot, it's created the tightest listing scenario I've seen ever.
And this is where you and I, we are utilizing our years of relationship building with these agents.
We are pulling every lever.
So that we get an inside run, because most of the time, once it hits the net, it's open slather.
Yeah, and I've actually even noticed, remember about, 6 months ago, it would have been 12 months ago, where one of my major soapbox moments on this podcast, and I think I did it. We also talked about it with Phil from SPI as well, about this whole off-market scenario.
No such thing.
Have you seen the rhetoric change lately? I've seen a few people start to say, off-market doesn't really exist, or doesn't necessarily mean that it's a ripper of an opportunity just because it is.
Look, bottom line, right? Simple logic. If you never had the intention to sell, the only reason you would sell is someone's made you a phenomenal offer that you can't say no to. So the intention to sell was always there. It's more pre-market.
Pre-market and relationships now is more, and this is one of the signs we use as trying to judge the tempo of a market, and as sort of unsophisticated as it is, the time it takes for an agent to call us back, or the fact that they even call us at all, is a really good gauge of the tempo of the market. So if we had have gone back during the lockdown, even though the market didn't contract, the communication with the agents, selling agents we're talking about here, was extremely high on both sides. And we're starting to see that taper off very, very quickly in terms of how long it takes for that phone call to be returned, which is even more of a reason that the relationships that we have are still cultured and kept, so that we do get heads up. doesn't not in the illegal sense, because the vendor will always be represented correctly by the selling agent. But if we just get 24 hours, 48 hours notice, our diligence is then 24, 48 hours in front of everybody else's.
That's true.
And it's very, very, can be a lucrative point.
Yeah. Now, we touched very briefly, Steve, on regional markets, right? And what the media is saying in terms of regional market absolutely outperforming and has outperformed all other markets. I think it would be really prudent to say over here that you have to take that with a grain of salt, right? Because yes, a lot of people have moved regional, but the definition of regional needs to be addressed in each state before we can decipher where this data is heading. So as an example, regional in Sydney would be distance from CBD, right? And it could be hour and a half, 2 hours or more, right? That would, in my mind, within 1.5 hours is still considered commutable distance back to postcode 2000 with the infrastructure that's here in Sydney. So therefore, it's more so metropolitan in nature, right? If you took the same thing back to, say, Victoria, Ballarat, which is hour 5 from Melbourne CBD, or Geelong, which is 45 minutes from Melbourne CBD, both are considered regional because of the lie of the land, because you've got a lot of vacant land in between. So there isn't a suburb after suburb after suburb scenario, right? So that if you look at those two markets in particular, they've done phenomenally well because it is still reasonable travel distance, right?
It's commutable. It's doable.
Yeah. In fact, if you look at it with both of those areas, you'd be able to get to major employment nodes, forget the area itself, but major employment nodes coming back towards Melbourne very easily. Yet from Melbournians or Victorians, it is still considered regional. So that does skew the data quite a bit and says that, well, regional areas have gone phenomenally well. A lot of people have moved to water, to coastal areas. Geelong is an example, a lot of coastal properties there. So, of course, that's had a spike. And we need to take that into account. The thing that we need to be mindful of is that not get caught up with the percentage growth. So if you're starting off with a value of 150 and it's gone up by 20,000, the percentage is far greater, isn't it? In comparison to something that's starting at 500 and it's gone up 50,000. Yeah. So you need to take that into account. But the biggest thing I think is that with all of these rhetoric, my opinion, this is the time to control as expensive an asset as you can within reason. So the cash flow needs to still be addressed as if the interest rates are above 4.5%, right? So you need to be able to control a sizable asset where the liquidity is still maintained. You've still got all of the fundamentals, and the key fundamental in there needs to be availability of jobs in a bad market.
I can now see the emails flying in on that comment.
Yes.
You've just created a whole heap of work in terms of the explanation.
So if you want to send an email, it's Steve at Right Property Group.
It's and maybe we should give a little bit more clarification around that in terms of controlling the most expensive asset that you can. It's based on your scenario, and I want to say it's based on your scenario.
I'm not talking about $1 million asset.
Yeah,
you go and buy $1 million asset. No, I'm not talking about that.
Correct. That's all I wanted you to say. But in some cases, it could be that.
Yes.
Yeah. It as you were saying that, I was thinking about one of our mantras, if you will, one of our pillars, which has always been cash flow. And at the end of the day, it's about multiple streams of cash flow because that negates risk to some degree. And if we're all in on one asset with a very skinny yield, just to reiterate what we've talked about for many, many years now, then the amplification of risk
is quite significant.
It's there. And it usually raises its head at the worst possible time. And the worst possible time is because everyone is in that same boat, i.e. an economy or whatever it may be. So Victor did not mean that you should be buying multi-million-dollar properties. For some it may be, but for others it
Diversification. You need to look at it from a viewpoint of, get out of jail card is the phrase that you need to use. In other words, things will go wrong. That's the attitude you need to have. Things will go wrong. You need to be comfortable that you'll be able to offload that property in a bad market without taking an absolute bath.
Correct. And that you actually can survive.
And it doesn't impact lifestyle while you're holding that property.
Which is always around cash flow.
Yes. Cash flow is king, as we keep
Always,
saying.
or cash flow management is king. So let's talk about the regional market just a little bit more, because whilst we may have just given the impression that we don't like regional, we
do like regional.
Yeah,
We've got regional properties ourselves.
Yeah, so we really like the first grade in regional areas, so to speak. Subpar, where there's not enough economy drivers, where it is isolated from the rest of the economy, yet it's still very much reactive to what the rest of the economy is doing, is not on our plate.
No.
I've been there, done that, and it just didn't perform as well. Like you can have all the positive cash flow. You can have 50 houses at $20 a week positive cash flow in middle of nowhere town, and you've just created you and a team of other people a job.
Yeah.
Where it doesn't take very much for that bottom line to shift into the negative very, very quickly. So what we're talking about here is we still want growth all the time. Growth is growth is growth is growth. We want the cash flow to underpin it so that it gives us time in the market.
Yeah. So just to clarify, we're not talking about positive cash flow properties, right? It's cash flow within your means, because when you look at a portfolio, that 2 stages or 3 stages it goes through, right? The first is the acquisition. And during the acquisition, there is an element of negative cash flow. And the element of negative cash flow is what you calculate without taking tax into account. So disregard the tax deductions. This is money in, money out, right? So let's say I can afford $400 a week to help hold on to my entire portfolio. Your portfolio needs to be shaped that way. Once you've done that, then you need to, of course, unencumber these properties at some way, shape or form. In other words, you need to pay them down. And there are different strategies that we'll go into detail in one of the podcasts where you pay them down. And once you've paid them down, you've harnessed the income, right? That's the holy grail of it, right? A lot of people focus on just one side of the equation. They either focus just on
accumulation.
Equity, accumulation, and I want $2 million of equity, and that's the goal, right? And they forget about cash flow management. So you need to be addressing both sides of it so that it's on an even plane, and that gives you the longevity and the ability to weather the storms, the economic storms that come along during your investing journey. So your COVID factor where the job becomes shaky. If you are carrying a massive negative cash flow property because your focus was totally on growth, you'd be having kittens, right? Because
and we have unraveled so many of those portfolios in the past. And as you were saying that around the return of cash flow, which is the holy grail, unencumbrance of debt is the holy grail, therefore the cash flow, unencumbered cash flow. You can't use the very generic formula, well, I want $2 million worth of property value returning 5%.
Doesn't happen.
It's just, that's a theoretical textbook-based throwaway line.
It's paper investing.
It's just not real world. Like, I don't mind taking a 3% yield. I'm talking unencumbered here. If it's growth prospects or it's a zone property where I can build 10 floors up, I'll take that.
So it's got a twist to it.
It's got a twist to it. And so this is every property in isolation, but how does it plug into into the portfolio so that every property has a reason for being there? Whether that's a portfolio of 2 properties or 22 properties, the same approach is necessary. And you also mentioned another interesting point saying, well, if you've got the capacity at $400 a week, and I know you just plucked that number, it's not around the one property.
No, the portfolio.
And this is how, as you said, this is how the portfolio is shaped based on that, as we refer to, the shortfall number.
Yep.
So it may not be 400. It might be a 100. It's a completely different approach to the person that's got a $400 a week capacity shortfall or $1,000 a week capacity shortfall. So once again, if I go back to earlier in the conversation around the free strategy session, it's a moot point.
Yeah. Yeah. So if you look at also one of the comments we made was that now's the time, given the interest rate, to try and buy the best type of property you can in terms of what it can do for the portfolio. A $100 a week portfolio holding capacity as opposed to $1,000, they're two very different properties now.
Absolutely, two different areas, two different price points, not necessarily two different results on a percentage growth based, but we're looking, maybe the best way to describe what you said is we're looking for the maximum exposure to the market that we can afford.
Yes. Yeah. Well put, Steve.
Oh, yeah. I get one a podcast. So we've got the finance. We've talked about the finance and how intricate it is, as we do on most podcasts, but that's how important it is. We've now given our thoughts and explanation around the regional areas and how we think some will perform over the long term, but we also think that how some of these regional areas are going to be a flash in the pan. Mm-hmm. And if you're a transactional investor, meaning you want to get in and get out, maybe they're for you.
Monetize hard.
Yeah, but maybe that's your bag.
Yeah.
Like, go do it. But it's just not us. We don't have that bandwidth to speculate.
Real estate is a slow transaction, right? If you're transitioning from holding to selling, it's a 2 month to 3 month process at best.
At best. And then at the time you get your money in the bank, it could even be longer.
And if it's a flash in the pan scenario, you would have missed the boat.
One of the questions that we got this week was around how do we alter, and I'm sort of changing tact here, but how do we alter the way that we negotiate now, or what's the difference in the way that we negotiate now to say it was pre-COVID?
Very different, extremely different.
What would you say is the major point of difference?
It's the terms. It's the terms, right? Yep. Because you need to understand what the vendor's motivation is to begin with. And given the relationships we hold with a lot of the agents we deal with, we are able to get an indication, right? They don't obviously divulge confidential information, but they do give an indication. And that is not because they're freely giving that. It's our years of shaping the conversation to extract pebbles along the way to get to that full information. So that's the first thing. The second is that the less terms you have in today's market, the more attractive your offer, because there are less hurdles to jump through.
I was hoping you would answer it that way, because I agree 100%. The less complicated you make your offer, the more chance it has of floating.
Yeah, so no funky deals like the textbooks or the seminars of the yesteryears are saying
money down.
Yep, doesn't work.
Transact on $1. Mm-hmm. I'm not going to get down on that.
They are on a very specific market. It works, and those markets I have seen very few and far between in my investing career.
And to be fair, you don't want that market because it usually means there is gallons of blood on the street, so to speak. So you're really buying into it. Anyway. But in terms of the way that we negotiate now, as Vic's pointed out, is wildly different than what we did 12 months ago, 24 months ago. And it's almost like we go back to our book and we say, right, we're in this market and we know how the fundamentals of negotiating work in this type of a market, and so we'll put this play into action.
Yeah.
Even the way we do auctions now is wildly different,
very different.
From back then. So the major point for me would be don't complicate it. Be progressive, be proactive.
Yeah.
You can't rest on your laurels. You can't play the slow game saying, well, they've counter-offered, I might just wait a couple of days and make them think.
Yeah.
It doesn't work.
There's too many players in the market right now that'll sweep it from under you, right? And one of the other common ones that a lot of investors come back with is giving them a low ball offer, right? You need to know where the value is, where the value lies of the property, and where the value lies for you, right, in your portfolio.
And that's a very good point, because lowballing today is just going to annoy the agent.
Yeah.
And you've probably just burnt a relationship, or the beginnings of a relationship, where they're just going to go elsewhere. Because as an investor, as someone who negotiates, you are expected to have a certain degree of knowledge around you on the offer that you're putting in. In other words, don't take Bill or Mary, the agent, or the seller, for a fool.
Yeah.
Ever. Not even in a bad market, but the way that you approach it today.
Yeah. Look, those sort of things used to work when the digital media wasn't here, right? Because the information wasn't as free-flowing. Now, everyone pretty much knows what the average values are in the area and what the recent sales are. It's as simple as jumping onto realestate.com.au and looking at the sold properties, right? So this is where you need to understand it from a value proposition, like I said before, of the value of the property and the value it holds in your portfolio. Sometimes it makes absolute sense to pay above odds to get that property, because now having the property adjoining to what you already own creates a development site, which is far more rewarding in the medium to long term, because you've grabbed the opportunity while it was there and you've pushed everyone away by paying a little bit above everyone else.
Because you've dollar cost averaged.
That's right.
On the proposition because you own next door. So once again, understanding the value of the market, what the real value of the market should shape the way in today's market anyways, how you make the offer. What would be the number one thing that you wouldn't do?
So many things I wouldn't do. The first is, just getting caught into the FOMO, right? I must get this property. I must get this property. Sometimes it is absolutely necessary to get that property in your portfolio because it fits into the plan and it fits into what you've already got in and around it. However, you shouldn't get into a Dutch auction scenario. Agents are really well trained and they will try and extract as high an offer from you as possible. There's always going to be a buyer, and in today's market, they're genuine buyers.
Yeah,
in the background.
Just remember that the agent's job is to get the most out of the vendor, out of the purchaser for the vendor. That's who they work for, and they spend thousands of dollars every year on honing their skill as sales agents.
Yeah,
and a lot of them are very, very good at it. And if it's something that you only do, annually, biannually, once every 5 years, you are already behind the eight ball. So once again, determining value will help shape the way that you negotiate or the strategy that you deploy to negotiate. But the number one thing for me would be to ask the right questions, then shut up.
Yeah, listen.
And just listen. It's amazing how much you'll learn when you stop talking.
Yeah.
Because the agents are human as well, and they're willing to, it's not a them and us scenario. They're willing to help you. And they will give you the right information as much as they can if you ask the right the right questions.
Yeah, absolutely, I agree. And one of the things talking about agents is you don't want to make it hard for them, right? You give them the reasons as to why you come into this price, and don't put BS into it in saying that plucking these sales and all, because they're the expert in that area.
Yeah, don't showboat. I remember I was at an auction once, and this guy turned up in a Bentley. No, I'm just joking. That's your car.
You had to bring that in, huh?
Every podcast, I'll get it in some way, shape, or form. But he turned up in the typical red Ferrari, revving its guts out as he turned up.
I think I know what you're talking about.
And sort of got out of the car showboating, because what he was trying to do is show people how much money he has, and
it was the wrong area to do it.
Way wrong area to do it. Anyway, and he registered to bid, and then the auctioneer asked for opening bid or offer, which is what they do every time, after their preamble. And this guy, before anyone else could raise their hand, throw a bid in, he said, "Just letting you all know that I've got plenty. My pockets are deep." And everyone looked at him as if not in a way of they were in awe or they were just psyched out. Everyone looked at him and said, "What a mong, like what a gronk." And the guy didn't even raise his hand once for a bid. And that auction actually got down to the auctioneer. We were down to $5 bids.
I remember that
at the end of it, which was crazy.
It was painful. That was the longest auction.
I aged about 3 years, and we didn't get the property at all. But so.
Obviously, you're down to your last fiver.
We just stuck around actually to watch the show at the end. So negotiation now is, once again, I'm repeating myself, very, very different. And I would say be engaged. Like, just go all in on your research and your knowledge base. If you're going to do this yourself, then be all in, because you're about to spend circa $500,000 or $1 million. So you want to get it right. Don't shortcut the process, so to speak. So we're quickly running out of time, Vic.
We are.
What would be, if you could, I'm going to ask a question now because we asked a question, I think it was this time last year, where I can't remember if you asked me or Phil asked me or I asked you, I can't remember what the question was. Where do you think are going to be the best performing markets? I think we said Sydney at that stage, and you can go back and listen to, I don't know, whatever podcast it was where we gave our answers. And
I think it was Facebook Live that we.
Was it Facebook Live? Was it?
And if you haven't listened to our Facebook Live, you can go back to the older episodes on our Facebook page. There's absolute gems of gold, and of course the slip-ups that Steve has when he mispronounces words. I never mispronounce any words.
I thought you were for real, but I'm thinking, have I done it again? Have I got your name wrong? So I'm going to ask you a reverse-facing question now. What do you think is going to be the most dangerous market over the next, I'm going to call it 3 years?
Yep, good question.
So it doesn't have to be the least performing market.
Most dangerous.
The most dangerous.
Yeah, I would say it would be the subpar regional, first off, right? And then your holiday areas, right? So this is, I don't want to name areas as such, but I'll give you a scenario. This is where traditionally we are reliant on overseas tourists, and there's a lot of infrastructure and all that. And now with the locals not being able to get out, this has shown huge returns, right? So all booked out, and vibrancy in the area. People have moved there because of COVID, but the fundamentals aren't there, right? So they would be the areas that would underperform or hurt people, because as finance gets easier, more and more people will get into those areas, but then finance will come a lot harder, right? Become a lot harder as they try and slow markets down. And this is where it will hurt people, because as borders open, people will also then start going overseas again and all that, and forget about these local areas and return to normalcy, where the yields that you're seeing right now simply will not be there.
You going to name an area?
No.
That was very wishy-washy.
Yeah, I'd say
the listener
all
wants
right,
to know.
I'm gonna put my foot in it. An area would be like that would be, say, Cairns, right? That would have quite a lot of issues as such once normalcy returns. Another area that people are moving into right now and is on the media and all that, and it's way overvalued, is Byron Bay.
Oh, those two comments,
I know,
are just going to light up.
Remember the email address to send your complaints to, Steve at right.
Do you know what? I'm going to agree and disagree. There you go.
That's an each way bet.
It is. I actually think Byron Bay and its surrounds will continue to perpetuate. Mm-hmm. It's now the in thing with overseas.
It's the clicky thing, right?
It is.
Yeah. But I'm talking more in terms of your local investors and locals buying off the back of that.
Yeah, you see, it's a really, and I know we're going to go over time, but I don't know, it's our show. I think that there's a certain degree of people that will work remotely for just about ever and ever.
Yeah.
Because
it's changed. It's changed forever.
Or they already have been. Right? And so there's this demographic shift, if you will, or positional shift is probably a better way to describe it, where they can go to your Byron Bay-esque times of area because they have the capacity, the technology, and that is their role, whether it be in the tech space, corporate space, exec space, whatever it may be. But the blue-collar worker will not be able to do that.
That's right.
Because they need to be where the work is, as an example, whether it be warehousing, building, Sparky, whatever. That's not where it's going to be. It will be for a small few, to be fair, but not for the majority. So there will be areas, could be the sunny coast, that continue to perpetuate, and that is the new norm. Could be Byron Bay as an example, but it won't be Burke.
No. Yeah.
And I say that with all the love in my heart for people out at Burke. I've spent half my life there. But that is not the next CBD. That is not
too far out. And whilst it's not subpar, the employment opportunities are limited.
Yeah. So you're catering for these types of areas which we think where I think will perpetuate, and we'll call them the regional areas, will have the capacity to cater for those that can do it as opposed to those that just want to but don't know how they're going to do. The Cairns one, I think it's always been one of our areas there. Whilst it's done okay, is it the best place that your dollar is going to work for you? That's the question.
Yeah. And in both of these areas, the overlying factor is if you get into a service department scenario, you're done.
So
that's what I'm leading to.
Yeah, and we speak from experience because I've told my story many times with mine. Vic's just shared his. I actually went
with much tears.
And a lump in his throat. I actually went past yours on Christmas holidays.
Uh-huh.
I threw rocks at it just for you.
That's cool when insured.
No, it was full.
We're rapidly out of time, Steve.
We are. So once again, thanks for listening. Thanks for coming in, Vic. It's the first one of the year. We've also got one in a couple of weeks, I think, with Phil Tarrant from SPI. We have our Facebook Lives, which we do every second week. But as usual, always contactable. Feel free to reach out to us at questions at Right Property Group. Hit us up on the socials, whichever ones they are. And we'll always come back to you. In the meantime, stay safe. Hope you enjoyed this podcast, and we'll see you next time.
See you then.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.